Hello everyone, and welcome to the Patient Protection and Affordable Care Act, brought to you by the Tax Reduction Network. I'm David Warrick, your host, certified financial planner, and host of the Tax Reduction Network. On March 23rd, President Obama signed the Patient Protection and Affordable Care Act. On March 30th, he signed the Companion Health Care and Education Reconciliation Act of 2010. Together, these two acts represent the biggest change in how we finance health care since Medicare was created in 1965. They also include some of the most significant tax changes in a generation. Healthcare reform has been an intensely political process. Not one single Republican voted for the law in either the House or the Senate, and polls show that Americans are overwhelmingly confused and concerned. They don't know just what the law does, they don't know how much it's going to cost, and that's no surprise considering the actual text of the bill runs over 2,500 pages. There's probably not a single person on the planet who really understands it all. Let's start with some of the changes that went into effect in 2010. On the tax side, small businesses with up to 25 employees earning $40,000 a year or less will get a tax credit for 35% of the cost of providing health care benefits to their employees. And who can overlook a new 10% excise tax on indoor tanning services that use certain ultraviolet lights? That rule took effect July 1 of 2010, just as outdoor tanning season goes into full swing. On the pre-existing healthcare side, insurers can't deny coverage to children for pre-existing conditions. They have to let children stay on their parents' plans through age 26. They can't set lifetime limits on plan coverage either. Finally, Medicare Part D recipients who enter the so-called donut hole will get rebates and discounts on prescription drug use. For those who don't know, the donut hole is a gap in prescription coverage where the government pays nothing and beneficiaries pay the full cost of the drugs themselves. Starting in 2011, employers will have to report the value of health benefits they provide employees on Form W-2. That doesn't mean the benefits will be taxable, but employers will face penalties if they don't provide that information. On the healthcare side, Part D Medicare recipients entering the donut hole qualify for discounts rather than rebates on their prescription drugs. 2013 is a big year for tax changes. Right now, medical and dental expenses are deductible if they exceed 7.5% of your adjusted gross income, or AGI. Unless, of course, you're subject to the alternative minimum tax, in which case they have to exceed 10% of your AGI. Starting in 2013, that floor rises to 10% of AGI for everyone, unless you or your spouse are 65 or older, in which case it stays at 7.5% of adjusted gross income, unless, of course, you're 65 and subject to AMT. If you participate in a healthcare flexible spending account at work, your contributions will be capped at $2,500 per year, with no contributions for over-the-counter medications. If your earned income is above $200,000 or $250,000 if you file jointly, you'll pay an extra 3.8% Medicare tax on earned income above those amounts. If you're in the top 3.9% marginal tax bracket that we can expect to see in 2012, these extra taxes could push your actual marginal rate well above 40%. If you're in the top 39.6% marginal tax bracket that we expect to see in 2012, these extra taxes could push your actual marginal rate well above 40%. Finally, you'll pay a 3.8% unearned income Medicare contribution on your investment income if your AGI is above these thresholds. Investment income is defined as interest, dividends, capital gains, rents, royalties, and annuities.